Welcome to LuckScout Economic News. Let's talk about something that affects us all, the economy. Whether you're a seasoned investor or just someone trying to make ends meet, the economy plays a crucial role in our daily lives. It's like the weather, always changing. One moment it's sunny, the next it's stormy. And just like the weather, the economy can be unpredictable, and just like you check the forecast before heading out, you need to keep an eye on the economic news. Staying informed can help you prepare for whatever comes your way. Why? Because it impacts your job, your investments, and even the price of your morning coffee. When the economy shifts, so do the prices of everyday items. So let's dive into the latest happenings and see what's what. We'll break down complex economic concepts into easy-to-understand insights. Knowing what's going on with the economy helps you make smarter decisions. Whether it's about your career, your investments, or your daily expenses, being informed gives you the power to make better choices. Whether you're thinking about buying a house, investing your savings, or even just planning a vacation, understanding the economic landscape can give you an edge. It helps you know when to act and when to hold back. So, stay tuned as we break down the latest news and what it means for you. We'll cover everything from job reports to stock market trends, and even how global events can impact your wallet. By the end of this episode, you'll have a clearer picture of the economic forces at play and how to navigate them. First up, let's talk about the Federal Reserve, often referred to as the Fed. This institution plays a crucial role in our economy, influencing everything from the cost of borrowing money to the overall health of the financial system. They're like the referees of our economy, trying to keep things fair and balanced. Just as referees ensure the rules are followed in a game, the Fed ensures that the economy runs smoothly and efficiently. One of their main tools? Interest rates. These rates are essentially the cost of borrowing money, and they can have a significant impact on economic activity. Think of them like the economy's speed limit. When the Fed lowers interest rates, it's like lowering the speed limit, making it easier and cheaper for businesses and consumers to borrow money. When rates are low, borrowing money is cheap, and businesses boom. This can lead to more investments, more jobs, and overall economic growth. It's a time of celebration for many business owners. But when inflation heats up, the Fed raises rates to cool things down. Inflation is like a fever in the economy, and higher interest rates act as a remedy to bring it back to normal levels. Right now, the Fed is being cautious. They are carefully analyzing a wide range of economic data to make informed decisions. They've been raising rates to fight inflation, but they're worried about going too far, too fast. Raising rates too quickly can slow down the economy too much, leading to a recession. Some folks think they should keep hiking rates, while others say they should hit the pause button. This debate is ongoing, with strong arguments on both sides. The Fed is watching the data closely, trying to find that sweet spot. They aim to balance the need to control inflation without stifling economic growth. It's a delicate dance, and the stakes are high. Stay tuned for more updates as the situation evolves. Next up, let's talk about oil. It's the lifeblood of our economy, powering our cars, heating our homes, and fueling our industries. And lately, oil prices have been on a tear. Why? Well, OPEC+, the big oil cartel, has been cutting production. Plus, we've got geopolitical tensions adding to the uncertainty. So, what does this mean for you? Well, higher oil prices mean higher gas prices, which eats into your budget. It also means higher costs for businesses, which could lead to higher prices for everything from groceries to airline tickets. Keep an eye on this one, folks. Now let's talk about jobs. Everyone wants a good job, right? Well, the job market is sending us mixed signals. On the one hand, we're seeing solid job growth, especially in the private sector. That's good news. But on the other hand, wages are still rising, which is fueling inflation. So, what's the deal? Well, it's a classic case of supply and demand. We've got more job openings than people looking for work, which gives workers more leverage to demand higher wages. The Fed is watching this closely, as wage inflation is a key factor in their interest rate decisions. Finally, let's talk about the service sector. This is where most Americans work, from restaurants and retail to healthcare and finance. And lately, the service sector has been slowing down. We saw this in the latest Purchasing Managers Index, which dropped more than expected. Now don't panic just yet. The service sector is still growing, just at a slower pace. This could be a temporary blip, or it could be a sign of things to come. We'll have to wait and see how it plays out. So what does all this mean for your investments? Well, in uncertain times like these, it's important to stay diversified and focus on quality. One option to consider is bonds. Bonds are like IOUs issued by governments or corporations. They tend to be less volatile than stocks, making them a good choice for conservative investors. Short-term bonds in particular can be attractive right now. They offer decent yields and are less sensitive to interest rate hikes. So if you're looking for a safe haven for your cash, bonds could be a good bet. Now, if you're looking for income, dividend-paying stocks are another option to consider. Dividends are like bonuses paid out to shareholders, providing a steady stream of income. And with the stock market still near all-time highs, there are plenty of companies out there paying hefty dividends. Look for companies with a long history of dividend growth and a solid track record of profitability. These are the companies that are more likely to continue paying dividends, even in a slowing economy. Another asset class to consider is commodities. Commodities are raw materials like oil, gold, and wheat. They tend to do well when inflation is rising, as their prices are often driven by supply and demand. If you're worried about inflation eroding your purchasing power, adding some commodities to your portfolio can act as a hedge. Just remember that commodities can be volatile, so it's important to invest carefully. Given the recent surge in oil prices, the energy sector is another area that could be worth a look. Oil and gas companies are benefiting from higher energy prices, which is boosting their profits. However, it's important to remember that the energy sector can be cyclical, meaning it goes through periods of boom and bust. So, if you're thinking about investing in this sector, it's important to do your research and understand the risks. With inflation still a concern, it's also a good idea to consider investments that offer some protection against rising prices. One option is Treasury Inflation-Protected Securities, or TIPS. TIPS are government bonds that adjust their principal value based on inflation. This means that if inflation rises, the value of your TIPS investment will also rise, helping to protect your purchasing power. So, if you're looking for a way to safeguard your savings from inflation, TIPS could be a good option. Staying ahead of the curve. Diversification is key. In today's fast-paced and ever-changing financial landscape, it's crucial to have a strategy that can withstand the test of time. Diversification is not just a buzzword, it's a fundamental principle that can help you manage risk and achieve long-term financial success. So, there you have it, folks. The economy is a complex beast, always changing and evolving. From market fluctuations to economic downturns, the financial world is full of uncertainties. But don't let that intimidate you. By diversifying your investments, you can create a safety net that protects you from the unpredictable nature of the market. The economy is a complex beast, always changing and evolving. It's like a living organism, constantly adapting to new conditions and challenges. Whether it's technological advancements, geopolitical events, or shifts in consumer behavior, the factors influencing the economy are numerous and interconnected. But by staying informed and being prepared, you can navigate the ups and downs and come out ahead. Remember, diversification is key. It's about spreading your investments across different asset classes to minimize risk and maximize potential returns. Think of it as a way to balance your financial portfolio, ensuring that no single investment can significantly impact your overall wealth. Don't put all your eggs in one basket. This age-old adage holds true in the world of investing. By diversifying, you reduce the risk of losing everything if one investment performs poorly. Instead, you create a balanced portfolio that can weather various market conditions. Instead, spread your investments across different asset classes such as stocks, bonds, commodities, and real estate. Each asset class has its own set of risks and rewards, and by combining them, you can create a more stable and resilient investment strategy. And most importantly, don't be afraid to ask for help. Navigating the financial markets can be daunting, but you don't have to do it alone. A financial advisor can provide valuable insights and guidance, helping you make informed decisions that align with your financial goals. A financial advisor can help you create a personalized investment plan that meets your individual needs and goals. They can assess your risk tolerance, investment horizon, and financial objectives to develop a strategy that's tailored to you. Stay informed, stay invested, and stay ahead of the curve. Keep an eye on market trends, stay updated with the latest financial news, and continuously review and adjust your investment strategy as needed. By doing so, you'll be better equipped to navigate the complexities of the financial world and achieve long-term success. Please like the video and share it with others. Thank you for watching.